Hi, good afternoon, everyone. Thank you for joining in. On behalf of the firm and my colleagues, I would like to welcome you to the first of a series of webinars we will be conducting over the course of this year on various elements of a deal process, their implications from a commercial, tax and regulatory, accounting and valuations perspective. The topic for today is a fairly interesting one. Definitely something that comes up fairly often in a deal environment, which is contingent considerations and earnouts in acquisitions. Over the course of these next 60 minutes or so, I, Aditya Khanna, who's a partner in the lead advisory practice of Grant Thornton, and my colleagues, Siddharth Talwar, who's a partner with the CFO advisory practice, and Manish Saxena, who's a partner with the valuations practice, will attempt to cover this often contentious issue that we see in any deal negotiation, both from a commercial, accounting, and valuations perspective. While we're going through this webinar, just in terms of housekeeping, while we're going through this webinar, in case there are any questions that you may have, do feel free to drop them into the chat window, and we will try and pick those up either at the end of the session, or we will reach out to you separately with our views on those questions post the webinar itself. So with that, maybe we'll kickstart, what contingent considerations are all about. And these are, as I said, structures which are fairly common in a deal environment. At a very simplistic level, a contingent consideration is any consideration a buyer is willing to pay a seller on the realization of certain future outcomes. If we could move to the next slide, please. What that fundamentally means is that if a certain milestone is achieved, or if a certain financial parameter is achieved or delivered, then based on achievement of such milestone or a parameter, a buyer pays a seller a certain consideration in a transaction environment. And while at a principal level, a lot of these structures are often used largely to bridge value gaps in terms of expectations of a buyer versus those of a seller. Principally, there are 2 or 3 key elements that one is trying to address through a structure like this. The first and foremost being the risk-reward allocation. What I mean by that is, how does a buyer protect themselves against a hockey stick business plan that one typically sees in a transaction year? How does a buyer protect themselves, for example, for improved business performance, improved outlook, which they typically end up seeing while they are looking to transact? And similarly, how does a seller benefit if they feel that a strategic investment by a buyer significantly changes the complexion of the business and creates disproportionate value going forward, not only for the buyer, not only for the seller, but for the buyer as well, right? So one of the principal areas or issues that a contingent consideration structure is trying to address is the risk-reward allocation between the buyer and seller through a transaction process. I think the second fundamental element, which also sometimes is a key objective of some of these structures, is to ensure alignment of interests between a buyer and seller. How does a buyer, for example, ensure the right transitionary support is being provided to them once they acquire a business, especially in conditions or especially in situations where the business historically had a higher degree of dependence on the shareholders themselves? And these, as I said, these are, I would say, 2 of the key considerations which drive a desire to look at structures like this. The principal and underlying motivator, obviously, as I said, in most situations is also to bridge valuation gaps on what the expectation of a buyer is versus what a seller is desiring to transact at. So that's a bit about contingent considerations and how or what are some of the situations they they arise in, or what are the issues that they're trying to address. But how are some of these contingent considerations often structured? Now, there are multitude of ways that a structure like this can get created. We often see financial thresholds, whether it's revenue CAGR, whether it's profitability linked matrices that are considered for creating such contingent structures. Often these are linked to product development or customer acquisitions. So for example, if there is a patent that is pending or a technology which is proprietary to a seller which has gotten created, not yet commercialized, how does one ensure that a patent on that technology is granted to the commercial viability of that technology is tested before a buyer puts any hard cash on the table for the seller for the seller to take home. So the structures themselves, the parameters themselves, whether financial, whether customer related, whether employee related, whether business or strategy related, could be a multitude of such considerations. But I think the key piece of any such consideration or any such parameter that one always needs to be mindful of is to ensure that whatever structure is adopted in a contingent consideration structure, or whatever parameters are ultimately used, are parameters which are easily measurable, easily identifiable, and have as limited ambiguity as possible. Moving on, I think let's look at a quick example of how a contingent consideration structure typically works out in a practical scenario, right? And this is something I'm sure as colleagues who are M&A practitioners or who have colleagues who have looked at transactions in the past would be fairly familiar with, where while a business is at a certain scale, certain trajectory at the year of transaction, when you look at the outlook going forward, there is a very different picture that is either painted by the seller, or in certain situations, the business itself may have gone through underlying issues, macro or micro, which has resulted in a performance which is not consistent with historicals of the business, right? So let's assume a situation like this, which you see on the slide, where a business which is about 120 crores in top line does an EBITDA of about 10 odd percent. In the year of transaction, however, the seller feels that with the opportunities that are in place, they can double the business in the next 3 years while improving the profitability profile of the business. Now, in situations like this, often it becomes extremely difficult to get to a point of alignment on a valuation upfront, and which is where consideration or contingent structures become extremely important to both to bridge value gap as well as to ensure that there is alignment of interest created. And a simple example of this is visible in the numbers that you see on the slide itself, where while a seller decides to divest 51% stake in a business at a predefined multiple based on the existing performance, a ratchet structure is created which incentivizes the seller to ensure that business scales up in the trajectory that is being projected at the time of exit. This ultimately leads to obviously disproportionate value creation for the seller themselves, but also offers two elements to a buyer, which is one, a business which obviously has scaled up fairly well over the next 3 years, as well as adequate transitionary support to ensure that a buyer can continue the business on the same trajectory in which it is inheriting post a potential transaction as well. I think moving to the next one, as I said, while contingent consideration structures are great, these are often also potential areas of disputes in any transaction. And it is therefore important to be mindful of some of the key considerations that one has to keep in mind while looking at structures like this. These considerations are often different for the buyers and the sellers, and ultimately need to be balanced carefully during any documentation that is executed as a part of a deal process. For a buyer, obviously, the considerations are more from a perspective of whether decisions that are being taken during that earnout period are decisions that are aligned to the long-term interests of the business. Is there cultural fitment between the buyer and the seller teams to ensure that the business itself operates in the desired way during that earnout phase? Because these are elements which also impact seller consideration, often it also means that a buyer needs to relinquish some operational control despite being a majority shareholder in the business. Finally, it also impacts the ability of a buyer to create potential synergies, given that integration itself may get played out only post a complete acquisition of the business itself. So these would be some of the considerations for the buyer. The last one also obviously being that in a lot of situations where you have sellers continue as shareholders, it also then limits the ability of a buyer to raise any acquisition financing or to use the cash flows of the business itself to service any debt that they may take for the purposes of the acquisition. The consideration for the seller, as I said, would be different or slightly different in that context, and which is where that fine balance needs to be ensured when negotiating some of these structures. The first one obviously is there's always a desire, given that you now have a majority shareholder in the business, there is always a desire for the seller to ensure that there is some base value that gets protected for them during the course of negotiations of such structures. It also is important for every seller and equally for the buyer to ensure that the interpretation of the earnout parameters are clearly defined in definitive documents. As I had said earlier, irrespective of the different parameters used, it's important that those parameters are parameters which are easily identifiable, are unambiguous, and clearly laid out in the definitive documents that one may execute for a transaction process. The third would obviously be some level of control that the seller can exercise to influence those parameters themselves, whether it's revenue threshold, whether it's profitability threshold. A seller would want some level of operational control to ensure the decisions that they take can adequately influence these earnout parameters. And the fourth, and often sometimes ignored and extremely critical element to be aware of, is what are situations where some of these contingent consideration arrangements can be terminated, which is your good lever, bad lever situations, which often need to be fleshed out in great level of detailing in definitive documents. So that's, at an overarching level, as I said, an overview of how contingent consideration structures play out in a deal environment. Obviously, at the time of deal execution and day one accounting of such structures is an equally important element that one needs to be mindful of. And for that, I will request my colleague Siddharth to come in and delve on that.
Thanks, Aditya, for giving us that background of this very interesting, complex, and a very innovative subject of earnouts and contingent consideration. And as we move further, in this country in terms of the volume of deals, the complexity is also going up and up. And with that, some of the participants on today's call who are associated with the legal profession, they would certainly agree that this is often one of the most argued over subject, both pre-deal and post-deal. So where I come in, is analyzing the accounting aspects of such clauses in the agreements, and because the impact of the valuation of such clauses, which we will talk about in a section immediately after this slide, is that the accounting of this has a significant impact on the financial statements. This becomes an extremely critical topic to just understand from an accounting standpoint. So I'll try to be as fundamental and basic to this as possible. So on a very broad note, the day one accounting for any contingent consideration or earnout structure is to measure it at fair value, and how that is done is what we will talk about in much more detail, very soon. The standard that is used in this case is Ind AS 32, which is critical for us to understand to determine whether that obligation to make that contingent payment to the seller, will that sit as a liability on my books or as equity in my books. That is governed by Ind AS 32. The value of that contingent consideration has a direct impact on the recognized goodwill in the financial statement. So if the liability for the contingent payment goes up, correspondingly, there would be an increase in the goodwill number as well on the financial statements. So that's day one. Day one, you recognize your contingent payment on its fair value, either as a liability or as an equity. We will come to that towards the later part of the webinar as to with some examples, real life scenarios of how that happens. On a subsequent go-to-forward basis, if you have classified your contingent payment as an equity, then you don't have much to do. You never remeasure your equity, and therefore there is no impact on your P&L. However, if you have classified that as a liability, then one would need to remeasure that through P&L, on a period-to-period basis. If subsequently, the contingent payment is diminished or is not met, say some of the thresholds or parameters that were set, they were not met, then you would reverse out that liability into the P&L and recognize a gain. Correspondingly, if the business does exceedingly well versus the expectations that were set at the beginning, basis which fair value was determined, then a differential impact is recognized as a loss in the financial statements. And therefore, it is very, very important that one is accurate, precise, in terms of measuring the fair value on day one. And that model is mature enough. It reflects the commercial understanding between the buyers and the seller. One should note that if the change in that fair value of consideration is because of certain information about facts or circumstances that even though existed at the acquisition date on the completion date, but appropriate information was not available, and subsequently you find out more information, the buyer finds out more information due to which the fair value of the contingent consideration changes, then that movement, that change in fair value does not go into your P&L. It straight away goes and affects your recognized goodwill. So, and that's called a measurement period adjustment. As some of you would know, Ind AS or IFRS allows the buyers a 1-year period to look at any additional information that they may have, and therefore, change their business combination account accordingly. So that's a very, high level accounting, aspects of it. In other words, first consideration, recognize either as liability or equity. If it's a liability, keep on remeasuring. If upon remeasurement there is a gain or loss, you recognize that in P&L. If on settlement there is a gain or loss, that also goes into P&L. Any measurement period adjustment does not go into P&L. So with that, let's look into what exactly is fair value. How is that determined? What are the various techniques? What are the various practical, challenges that arise in that? And for that, let me invite my colleague partner, Manish Saxena. Manish, over to you.
Yeah. Thanks, Sid. Good afternoon, everyone. Pleasure to be part of this webinar. Can we move to the next slide? Yeah. Next, please. Yeah. So, as Sid mentioned, once the transaction is consummated, the way the accounting happens and the transaction gets accounted creates a lot of volatility in the balance sheet and the financial statements of the acquirer. And that one of the biggest contributor to the volatility is the earnout and the contingent consideration, which is a component of the purchase consideration. So depending on the accounting treatment, the purchase consideration needs to be surely valued on day 0 or day 1 of the transaction, but it is also required to be valued subsequently at every reporting period. And the valuation of the contingent consideration becomes a very important element to the accounting. So in this section, we'll look at how do we really come up with the fair value of the contingent consideration. Now, before that, before we get into the valuation methods, let's spend some time and look at what are the different types of common contingent consideration structures that we come across in various transactions. I guess my colleague Aditya already touched upon some of the types of contingent consideration structures, but we'll look at it from a more technical standpoint here. So let's start with the most common and simple contingent consideration structure, which is also known as a deferred payment structure. So the way this structure works is there is a upfront payment for the acquisition of 100% stake, or let's say controlling stake, and there is a certain amount which is paid at a future date. Now, this amount is not linked to any event or contingency. This is a guaranteed amount which is paid at a future date instead of paying upfront. So that is why it is known as a deferred payment structure. So that's very simple. I will not get into the business rationale for why this is structured like this, but it's a very common structure that we come across. The second common contingent consideration structure that we come across is a milestone-based payment. So the way this works is there is a upfront amount which is paid at the time of acquisition, and a certain amount is paid in the future, and the payment of that is linked to an event or a milestone. So for example, 20 million in a transaction, 20 million gets paid upfront, and 5 million is paid in future at the end of 1 year, depending on whether the company gets an FD approval. If the target is in the pharma sector and it's developing certain products, pharma products, the contingency could be getting an FD approval, and if the FD approval happens, 5 million will get paid. So the payoff will look something like that, which you can see on the right side of the slide. The other common structure is a linear structure, where in addition to the upfront payment, there is a future payment which is linked to an underlying financial metric like a revenue or an EBITDA, and a certain percentage of that financial metric gets paid after a period of time, which could be 1 year or 2 years. So in this example, in addition to the fixed consideration of 20 million, 30% of the EBITDA will get paid at the end of first year. And the payoff will look something like this on the right side, the graph that you can see here. And this is called linear because, as you can see from the graph, the payout is completely correlated with the underlying metric, which is EBITDA. So higher the EBITDA, higher is the payout, and vice versa. So it's completely linear in that sense. We can move to the next slide. The other type of structure that we come across is a threshold structure, which is quite similar to the previous one that we saw, the linear structure. The only difference here is that there is a threshold defined for the triggering of the payment. So for example, if I take the same example, it's 20 million gets paid upfront, and 30% of the acquiree's excess EBITDA over 2 million gets paid to the sellers after 1 year period. So there is a threshold defined here. It's not a linear structure because nothing gets paid if the EBITDA is below 2 million. Only if it is above 2 million, 30% of the excess amount gets paid to the seller. So there is a threshold structure in this case. The other common structure could be a threshold with a cap structure. So again, this is quite similar to the previous two. The difference here is that in addition to the upfront payment and linkage to the EBITDA and a threshold, there is also a cap. So if the EBITDA after 1 year is above 2 million, In the previous structure, there was no limit. Anything above 2 million, 30% of that was getting paid. Here, there's a cap of 3 million. So that is where the payoff, if you see on the right side, looks like this with a cap. So this is a threshold and a cap structure. The next common structure that we come across is a multi-period path dependent structure. And in fact, this is the most common structure that we are seeing nowadays. As Sid mentioned, the deals are becoming more complex, and this is at least out of, I think, 5 out of 10 transactions that I would have worked on, this is the most common structure that we have seen, which is multi-period path dependent structure. So here the payment is unlike the previous one where the payment was a single period payment at the end of 1 year. Here the payment is spread over 2 to 3 years, and it is linked to again a financial metric like a revenue or an EBITDA. So for example, here the additional payment will be made, which is 30% of EBITDA over 1 million in first year, 30 in the next year 30% of EBITDA above 2 million in the second year, with an overall cap of 3 million. So first of all, this is multi-period because it's getting paid over 2 years, and why we are calling it as path dependent is because what gets paid in the next period also depends on how much was paid in the previous period. So for example, in this case, if the company or the target does really well and the EBITDA exceeds 1 million significantly, and the 3 million gets paid in the first year itself, and because there's a cap of 3 million, there will be nothing paid in the second year, right? So there is a path dependency here because what gets paid in the second year is also dependent on what gets paid in the first year. So this is a path dependent contingent consideration. The last structure which we see commonly, it's not very common, but we have still often seen this, is something known as a clawback structure. So here, the difference is that the acquirer pays everything upfront. There's no payment in the future by the acquirer. But at the end of an evaluation period, which could be 1 year or 2 years, if the target has underperformed, the acquirer will claw back a certain amount which has been paid initially to the extent of the underpayment, depending on the formula which is defined in the agreement. So here the payoff is something like a put option, and we'll look at it shortly how to value these structures. But these are some of the common contingent structures that we come across. You can move to the next slide. Yeah. So now that we have looked at different types of common contingent consideration structures, let's look at how we can categorize these structures in terms of the risk that the payoff from these structures are exposed to. And why do we need to look at this classification? It is important to categorize these structures by the risk, is because that classification will then further determine the methodology that we will use for the valuation of these contingent consideration. So the first way to classify these contingent consideration by the risk which the payoff is exposed to is by looking at whether the risk is diversifiable or non-diversifiable. So if I look at the first category, which is the diversifiable risk, we covered one example earlier where it was linked to the FDA approval, right? So what we call as diversifiable is any risk which is purely limited to that company. So something like achieving an FDA approval or getting a favorable legal dispute resolution, timely completion of a construction project and things like that. All these events which are very specific to the company are known as diversifiable risk. And why are they called as diversifiable? Because as an investor, I can easily diversify anything which is specific to a company by creating a portfolio of my investment. For example, if I want to invest in an IT company and that IT company is facing one company specific risk, I can invest in 5 IT companies. That way, I am diversifying that specific risk and eliminating to a large extent that risk. So that is why it's known as a diversifiable risk. The other category is the non-diversifiable risk. So we saw some structures earlier which were linked to the EBITDA or revenue performance of the target. Now these metrics and the linkage of the payment to these metrics is known as are exposed to non-diversifiable risk. And the reason we call it as non-diversifiable is because these risks are not specific to the company. In the same example, even if I invest in 5 IT companies, all these IT companies will be exposed to certain industry or the economy risk, and their revenue and EBITDA will be exposed to those risks which I cannot diversify away by investing in a portfolio. So that risk I will have to still live with even in a diversified portfolio, and hence that is known as a non-diversifiable risk. We can move to the next slide. Another way to categorize the risk inherent in the payout from the structures is to look at it as a linear or non-linear risk. So what is a linear risk? If the, and we saw one example earlier, if the payoff structure does not have any threshold or a cap, the third or second, I think, example we saw was completely correlated with the EBITDA. So it did not have a cap or a floor. And that structure is known as a linear structure, where the risk of the payoff is exactly same as the risk of the underlying metric, which is EBITDA or revenue. So this is a linear structure. What is a non-linear risk structure? It is a structure where there's a cap or a floor or a threshold defined in the payout. Now, why is this important? Because the moment you have a threshold or a cap or a floor in the structure, the risk of payout increases disproportionately. Because if I take an example, if there's a cap, let's say there's a threshold of 2 million of EBITDA, even if the EBITDA is 1.9 million, there is a zero payout. Unlike a linear structure where even if the EBITDA is lower, there will still be a payout. In a non-linear structure, if it's even a 0.1 million shortfall from the threshold, there is a zero payout. So the risk is disproportionately higher in this kind of a structure. So that's the second type of categorization. We can move to the next slide. Now, once we have analyzed all the types of structures and looked at the nature of the risk which is inherent in that structure, we can choose an appropriate method of valuation. There are two valuation approaches which are available with us to value an earnout structure or a contingent consideration. The first is known as a scenario-based method. What does it involve? So in a scenario-based method, we create multiple scenarios of the possible outcomes of that milestone or an event in the future. We then, in each of those scenarios, calculate the expected payoff and apply a probability of that scenario on that payoff and calculate a probability weighted payoff in the future. And that probability weighted future payoff is then discounted using an appropriate discount rate. So that's a very simple method to understand. Now, how do we apply this method in the different structures that we discussed earlier? So that again depends on the risk classification of that structure. So if it is a structure with a diversifiable risk, which we just now saw, if it's a structure with a diversifiable risk, the approach remains same. The way discounting happens differs. So if it's a diversifiable risk like a FDA approval or a dispute resolution, then the probability weighted payoff is discounted using a risk-free rate and a counterparty credit risk. Because as we saw earlier, this risk, nobody will pay a premium for the diversifiable risk because it can be easily diversified. And hence the only risk left is the credit risk of the acquirer defaulting. So that's factored in the discount rate. The second applicability of SBM approach is in a linear payoff structure with non-diversifiable risk. So here again, the approach remains same. Here non-diversifiable means it may be linked to an EBITDA or a revenue forecast, but we still create multiple scenarios of revenue and EBITDA, and then the probability weighted value is discounted using a discount rate, which also factors a risk premium for the non-diversifiable risk. So that's the difference between a non-diversifiable and a diversifiable structure. Now, the third category that we saw earlier, which is a non-linear risk structure. So this is where the applicability of SBM is limited. We cannot apply SBM in a non-linear payoff structure. And the reason for that is because, as I mentioned, the risk is extremely high in a non-linear payoff structure. You cannot quantify that risk in the discount rate like we did for the non-diversifiable risk earlier. We cannot quantify the risk in a non-linear payoff structure, and hence this approach becomes limited. So for such structures, we have another approach, which is known as an option pricing method approach, where we look at the contingent structure as options, and these structures are valued using an option pricing method like a Black-Scholes method or a Monte Carlo simulation. Now, between Black-Scholes and Monte Carlo simulation, the choice of method depends on whether it's a simple non-linear structure with just one threshold. Then you can use a Black-Scholes model. If it's a path-dependent multi-year structure, then the only method that you can use is a Monte Carlo option pricing method. And we'll quickly take an example to see how it is applied. So this is an overall approach to carry out a valuation of a earnout or a contingent structure. We can move to the next slide. So what we'll do is we'll quickly look at 2-3 case studies or example to understand the valuation approach better. And we'll start with an example of a contingent consideration linked to a diversifiable non-financial milestone. Right. So in this example, the acquiree has a drug under development, and company A, which is the acquirer, is a much bigger company. So company A acquires this company which is into drug development, and company A will be required to pay the sellers an amount of 2,000 in the event the acquiree drug currently under development receives the regulatory approval within a year. So this is a non-diversifiable milestone, right, and the risk. So here we will use an SBM approach, scenario-based method, and we have considered 2 scenarios. One where the company will achieve the FDA approval. The second scenario is that the company will not receive the FDA approval. And let's say we estimate a 50% probability of each of the scenarios. In each scenario, then we estimate the expected payoff, which is 2,000 and 0, and the probability weighted value comes to 1,000 as the expected payout. Now this is a future value, the probability weighted value of the payoff in future after 1 year. This, as we mentioned earlier, here we are the only risk remaining in this 1,000 is the credit risk of the acquirer defaulting, that is the company A defaulting, right? So when we are present valuing it to current value, the valuation date, the discount rate we are considering is the risk-adjusted risk-free rate, which is something like a cost of debt. And using that, we discount it to present value. 957 becomes the fair value of this structure. So that's a simple approach to value non-diversifiable consideration. Moving on, the second type of risk structure is a linear contingent consideration linked to non-diversifiable financial milestone. So here, company XYZ has acquired a controlling stake in company ABC, wherein the purchase consideration includes an earnout of 10% of ABC's EBITDA in the first year post-acquisition. The management has shared a forecast of 3,000 EBITDA in the first year. So with that forecast, how do we come up with a valuation of this consideration? So here again, because it's a linear contingent consideration and it is exposed to linear non-diversifiable risk, we can use a scenario-based method. So we'll consider 3 scenarios, base case being what has been provided by the management, 1 high case and low case, and we'll assign probabilities, higher probability being considered for the base case provided by the management. Here we again estimate the probability weighted earnout, which is 300. Now, when we are discounting this 300, the difference here compared to the previous example is that we will use a discount rate of 10%, which is factoring the non-diversifiable risk premium. And the way we estimate this discount rate is based on the beta. A lot of you would know what beta is in the context of a company valuation. And beta is nothing but a measure of a company's non-diversifiable risk. And here, because we are measuring the non-diversifiable risk premium, we start with the risk-free rate and add the beta multiplied by the market risk premium. That gives us a base WACC. That is why it's known as an adjusted WACC. And 300 is discounted using this WACC to get to 285. Now 285 is factoring the non-diversifiable risk that we have already adjusted here. What then remains is the credit risk. So we again take 285 forward by 1 year with a risk-free rate and discount it with a credit risk. And that then factors the credit risk as well. And we get a final fair value of 279. So this is the way we value a linear contingent consideration with a non-diversifiable risk. The next common structure is a non-linear contingent consideration, which is linked to a non-diversifiable financial milestone. So in this example, company XYZ has acquired a controlling stake in company ABC, wherein the consideration includes an earnout of 10% of excess EBITDA in the first year with a threshold of 3,000. So it is not linear. There's a threshold only above threshold of 3,000. There will be any payment made to the sellers. So here again, the management gives us a forecast of 3,000. Now here, if you see this graph, the payoff looks like a call option payoff. So we will model it like a call option, and we'll not get into the Black-Scholes formula in detail, but this is the formula. And if you look at it as a call option with an exercise price of 3,000, which is a threshold, and the asset price being what management has forecasted, you can estimate the volatility, and that will give you an option premium of 396. So this option premium is nothing but the risk-adjusted value of the potential scenarios above 3,000 of EBITDA exceeding 3,000, right? That is represented in this call option premium of 396. Now, because 10% of the excess EBITDA will get paid, we take 10% of 396 and then again adjust it for the credit risk. And that gives a value of 35 as the fair value of the contingent consideration. Moving on, the last structure that I want to cover is path dependent. I touched upon it earlier. What do we mean by path dependency? That is, it's the same structure here where there's a cap, overall cap of the total payment, but it is spread over 2 years, 10% over and above the threshold in first year, and another 10% of EBITDA over and above 4,000 threshold in the second year. Now, this is again a non-linear structure, so we cannot use an SBM. And hence we will use an option pricing model, but we cannot use a Black-Scholes because this is path dependent. And hence we will use a Monte Carlo simulation. And Monte Carlo simulation is again a option pricing method, but we'll not get into the nitty-gritties of the Monte Carlo simulation. We essentially take a log normal distribution and we carry out a simulation using Monte Carlo technique. So that's in a nutshell the valuation approach that we consider for valuing different types of earnout structures. With that, let me hand over back to Sid to talk about some of the nuances of accounting of these structures. Over to you, Sid.
Thanks, Manish, for simplifying such a complex subject. Of course, these models are extremely complex, and experts like Manish, they are here to help us out, with them. Let's quickly look at some of the nuances when it comes to accounting, really, and I've tried to cover, 2 or 3 of them, in the next 3 or 4 slides. The first one is, about variability in the number of shares. So, quite often the consideration is settled through issuance of more shares by the acquisition of shares of the acquirer, per se, through a share swap. And on many occasions, such contingent consideration is not fixed. It is in terms of a variable number of shares. In general parlance, it is, any variability in the issuance of number of shares is classified as a financial liability. As some of us who follow accounting standards and are responsible for accounting would know that a financial liability is any contract for which the entity, which in this case is the acquirer, is or may be obliged to deliver. There's an obligation to deliver a variable number of your equity instrument, that is the acquirer instrument. So that is the basic definition of a financial liability. Now, having said that, there are still possibilities where you may be issuing a variable number of shares. And Manish talked about various scenarios like particularly the multi-year path dependent scenario. If I were to pick that up and try and contextualize it from an accounting perspective. So let's look at two examples. In the first example, the acquirer will issue an additional 100 shares. So there is a consideration, let's say a consideration of 10,000 shares or 5,000 shares was already paid to the acquiree's owners, the selling shareholders, and additional 100 shares will be issued if the EBITDA of the acquiree is 50 crore plus in the first year, and another 200 shares if it is 75 crores plus in the second year, and an additional 700 shares if the EBITDA is 100 crore plus in the third year. So if all the three conditions are checked off, then the selling shareholders will get another 1,000 shares in the acquirer. Now, in this case, while the number of shares is variable, because if only first year condition is fulfilled and not the year 2 and 3, you get only 100 shares. If only second one is fulfilled, you get only 200 shares, and so on and so forth. While there is a variability, however, these scenarios are independent of each other. You can have a scenario where you meet the condition in year 1 and year 3 and miss out in year 2, and you would still get 100 plus 700, 800 shares. So such variabilities, which are independent of each other, do not violate what in accounting parlance we call the fixed for fixed rule. So therefore, it is still considered as settlement of the transaction by issuing a fixed number of shares. And therefore, from an accounting point of view, it gets classified under equity. So any fair value of these shares based on the model that Manish talked about, that would not go and sit as a liability. It would actually go and sit as equity. On the contrary, if we look at a parallel example, that 100 shares, if EBITDA for year 1 is 50 crores plus, 300 shares. So in the previous example, we had 200 additional. So now I have made it cumulative. 300 shares if EBITDA is 62.5 crores. So 62.5 crores, if you actually see, is the average of 50 and 75. So I'm saying if the average EBITDA for the 2 years is 62.5 crores per annum, then 300 shares. And the average EBITDA is 75 crores plus in 3 years, then 1,000 shares. So it is exactly economically speaking, it is the same payout. The only difference is that now every year is linked to the other. Now, if there are interdependencies in terms of variability in the number of shares, then such an arrangement will be looked upon as a liability classified, and therefore any changes in the fair value of such a consideration will continue to impact your P&L. So this is an example of the multi-year path dependent model which Manish talked about, but dependence and interdependence, independence or interdependence in two different scenarios. Independent, then you classify as equity. Interdependent, you classify it as a liability. Why it is important? Because you will remeasure liability every period and you take the impact to P&L. Moving on, if we look at a couple of more examples which we have seen in the recent past, let's say an entity acquires shares of a pharma company and the consideration is to be provided in the form of upfront cash, some deferred cash, and 100 equity shares. And that deferred cash payment is dependent upon the receipt of a FDA approval, pretty much similar to the example which Manish also took. Number of equity shares to be issued will only vary in case of any share split, bonus issue, or other things. So if there is a share split or bonus issue that happens, then to compensate for those corporate events, the number of shares will be varied. Now, deferred cash payment is a contingent consideration, which will be considered as a financial liability on the acquisition date at its fair value. The variability in the number of shares, the 100 shares, that we talked about, with that is linked actually to safeguard the interest of selling shareholders. So if you see, there is a binary outcome. If the FDA approval comes in, you get 100 shares. If the FDA approval does not come in, you get 0 shares. So there is no variability as such other than certain corporate events. Such a variability is considered as anti-dilutive, and therefore it is not considered as a liability classified, variability, and the instrument gets classified as a equity. The contingent consideration gets classified as a equity. On the contrary, if we look at another example where the acquisition agreement provides for issuance of shares upon receipt of FDA approval, same as the previous example, but the number of shares will be based on 10% of the paid up capital of the acquirer entity at the FDA approval date. Now, the number of shares in the entity can change for various reasons. There could be a buyback, there could be a new stock issuance, there could be an ESOP that might have been issued to the employees, and that might change the capital structure of the acquirer entity, because of which the number of shares which are to be issued for settlement of the contingent consideration, they may vary. Such variabilities will continue to be classified as a financial liability, and every period end, one would make a reassessment and do a fair valuation of the scenarios and take the resultant impact into P&L. Moving on to another nuance, in accounting for such instruments. If we can move to the next slide, please. Is many a time contingent payments are made to employees or selling shareholders. So sometimes selling shareholders, they continue as managing directors or CEOs of the acquired business for a certain period of time. The aspect to look into in that is that really a consideration for the business combination? Are you paying for the business that you have acquired? Or do you need to look at it separately? When I say you look at separately, means is that a remuneration for the continuing employees? So if an earnout arrangement is classified as a remuneration, then in that case, one will need to figure out if it is settled in shares, then you follow what we call as the ESOP guidance or the share-based payment guidance. And if it is to be settled in cash, then we treat it as a normal employee benefit. And I'll come to some of the factors which the standard itself has provided as to when something is a remuneration and when something is a consideration. If we determine it to be a contingent consideration, then it would go on and impact your goodwill that is recognized on day one, which I talked about earlier. So very critical, whenever contingent payments are to be made to selling shareholders who are also going to be employees, then one needs to look at, should I classify that as a remuneration? Remuneration will impact the P&L of the acquirer. Contingent consideration will not. Contingent consideration will straight away go into goodwill. Only the revaluation or the remeasurement of the contingent consideration will go to P&L, but the consideration itself will not go to P&L, unlike remuneration. So what are some of the factors? And if we can move to the next slide, where we talk about this in more detail. If there is a continuing employment, and that's what I want to highlight here. If there is a continuing employment, which is the criteria for the payment of the contingent consideration, then by default, it is considered that the contingent consideration is actually a remuneration for the employee and is not for the purchase of the business. On the other hand, some of the other aspects that I will talk about, they are actually indicators. So if there is one will need to consider what is the duration of employment that is expected. If the employment period of a selling shareholder is expected to be almost the same as the contingent payment period, then it is actually a remuneration. But if it is shorter or much longer, then in that case, possibly that payment is not a remuneration. It is a payment for the business and therefore should go into goodwill. Similarly, level of remuneration of the selling employee. If the remuneration of the selling shareholder is reasonable compared to the other key employees, then the contingent payment is likely part of the consideration transferred. So if he's otherwise getting, let's say, a package of 1 crore, which is also reasonable considering skill sets of other key employees in the company, and there is a contingent payout which is agreed as part of the acquisition, then that contingent payout shall not be considered towards remuneration because he's getting a fair remuneration otherwise. Anything additional is actually to compensate him for the business that he had sold to the buyers. Any incremental payments being made to the selling shareholder employee. So if the contingent payment amount is uniform for all the selling shareholders. So let's say somebody is a seller continues in employment and some of the other selling shareholders do not continue in employment. But if the contingent payout is the same to all of them, then it is obvious that, this is not a payment for the services, it is actually a payment for the business that has been sold. But if the selling shareholders are getting anything over and above, as compared to those shareholders who did not continue as employees, then likely that additional payment is for that remuneration for providing the services to the company after the acquisition. Similarly, number of shares which are owned, the higher the number of shares which are owned by the selling shareholder, the contingent consideration is likely to be a profit sharing arrangement, like some of the linear structure that Manish talked about, where a certain percentage of EBITDA is given. Now, if that clause is for a shareholder who owned a substantial stake in the business, then that would likely get classified as a remuneration and therefore go and hit the P&L, versus a shareholder who owned a very small stake and his or her contingency was linked to the EBITDA of the company, then that contingency would become a consideration. Similarly, linkage of the formula and the formula itself. What was the formula? What was the commercial dealing between the buyer and the seller? That also has an impact on whether it is a contingent consideration or it is a remuneration. So these are just few indicators which are given in the standard itself. In practical life, there are far more complexities which do arise. However, due to paucity of time, we will not go into all of them. Definitely, I would say that one needs to consider each of these complexities before arriving at the right decision, and that means that a lot of consultation is needed in that regard. With that, I would hand it over back to my colleague Aditya, for any closing comments and whatever we have assimilated from this.
Thanks, Siddharth. Thanks for trusting the deals guy to close things out. But I think extremely informative. And I think while it's been a session full of technical nuances and we've only sort of touched upon some of these pieces, I'm fairly certain while as a group we've tried to assimilate each of these. I think my only takeaway to the entire audience would be, if you don't remember anything from this session, there are two things that you should remember. The first is that contingent consideration structures are extremely pertinent in a deal environment. It is, however, often in the interest of both parties to have simple, clear, identifiable, measurable contingent consideration structures to avoid any potential disputes. As innovative transaction structures emerge, their accounting and valuation will become more and more complex as well as judgmental. It is therefore, as Sid alluded to, it is therefore important for buyers to consult their accounting advisors, their valuation advisors before they sign on the dotted line, to avoid any unintended consequences onto their books post an acquisition, and also to ensure fair and objective reporting on an ongoing basis post transaction closure. So with that, I know we are at time, but if there are any questions that we can help address, happy to take those. Otherwise, as we said, you feel free to put those questions in the chat box and we will come back to you subsequently as well. As we had mentioned at the start of this webinar, this is the first of a series of webinars that is being planned on some of these issues which are pertinent to the deal environment. We will come back potentially in the week or in the month of July with our next webinar. The dates and the topic for the same will be communicated shortly.
Okay. Do we have 5 minutes for Q&A or we are on time?
I think we're on time, but we'll be happy to wait for a minute and see if we get any questions from the participants.
I can see a few questions which have been already answered by our colleagues. Maybe if there are any other questions which you are not able to ask now, please feel free to drop a mail to us and we'll be happy to revert on those questions.
Like somebody has said about taxation aspects. Yes, we are going to, as Aditya mentioned at the beginning, this is the first in a series of webinars that we're going to do around transactions. Earnouts is a very hot topic, so we picked that up first. The tax aspects of earnouts and several other complexities of the deals will also be dealt with in the future sessions. As regards contingent consideration, is it always adjusted against goodwill? No, it's not. It's in fact very rarely adjusted against goodwill. Only when in the measurement period, which is within 1 year, you get some more information which you didn't have at the time you close the deal, then you can. Otherwise, it all goes into P&L.
I don't see any more
Okay.
questions coming in
Yeah.
at the time. So, maybe we will conclude this webinar. As we've said, please feel free to reach out to us for any further questions. And even if it's post the webinar, we are happy to come back to you with our thoughts on the same. Thank you so much for your
Thank you,
participation,
everyone.
and forward to
Thanks,
seeing
everyone.
you in subsequent sessions as well.
Thank you.
Bye-bye.
Bye-bye.